Well, I hope you found the conversation on taxing of your credit cards and decongesting the city informative. That was about that with Dr. Paul Kibicho and George Mboya. Now we cross over to our next segment, and we want to talk to one lady, Lena Cheng. She's the assistant manager at KRA Corporate Policy Unit. What are we talking about? Now today, we want to take you on a learning session where we help you understand various tax terms and put meaning into them. Now today we look at double taxation. What is it? Who is it for? Who does it affect? And to unpack this, as I mentioned earlier, we're joined by Lena Cheng, who serves as the assistant manager at KRA Corporate Policy Unit. Lena, thank you for making time.
Thank you so much, Ondiro. It's nice to be here.
Okay, great. Now let's just get into it. What is double taxation?
So double taxation, I'll explain it by telling you, by explaining the two types of double taxation we have. So we have what we call economic double taxation. So economic double taxation occurs where the same income is taxed in the hands of different people. So an example is for a company earns profits. So the profits of the company is subjected to tax, so what we call corporate income tax. And when they distribute that profits to the shareholders as dividends, then those dividends are also subjected to tax. So that is what we call economic double taxation. Then we have what we call juridical double taxation. So this is the income of a person taxed in more than one state. So for example, you, Ondiro, if you have a business here and you also conduct that business in Uganda, so in that case, Kenya will tax you and also Uganda will tax you. So Kenya will tax you as a resident of Kenya and Uganda will tax you because you're deriving income from their country. So that is what we call juridical double taxation, and that is the one that the double taxation avoidance agreement seek to address. So in short, that is what double taxation is.
Okay, great. Now you've touched on to the second question, what are double tax agreements? And talk to us about that in detail.
Okay, so a double tax agreement is an agreement that a country, or rather two countries, get into so as to eliminate double taxation. So the full name is actually Avoidance for Double Tax Agreements. So the double tax agreement is just a short form, an acronym, because it's easier to say DTAs than saying ADTAs. So, so if a country, like the example I gave of you conducting business in Kenya and Uganda, so that in the case where Uganda wants to tax you and Kenya also has a right to tax you, so to protect you as an individual from being taxed twice and therefore bearing a huge burden of taxation, Kenya and Uganda will then sign a double tax agreement to say that where Uganda has taxed you, then when you come to Kenya, Kenya says, yes, you have this income and you are taxed. So we will compute the tax, but we will relieve you from the tax that you paid in Uganda. So you get a deduction, or rather you get a relief, a credit, what we call a credit, from the tax that you pay in Uganda. So let me just explain further. So if the tax on that income that you earn both in Kenya and Uganda is 100,000, for instance, right? So Uganda taxed you, let's say 30,000 Kenya shillings, or rather 30,000 shillings, and said that that is the tax that you should have paid in Uganda. So when you come to Kenya, we compute your tax and we say you're supposed to pay 100,000, but we recognize that you've already paid 30,000 in Uganda. So we'll only require you to pay the 70,000. So that way you do not suffer the full burden of being taxed in both countries on your full income. That is what the double tax agreements are meant to address.
What led to the formation of this agreement? Because it serves business, but when you look at it in retrospect, countries still want to make money. How did they get to this compromise?
So the reason why countries got into this compromise is because they wanted to encourage cross-border trade, right? Especially for us developing countries, we are looking for investments to come in so that you can get FDI. So if you want to encourage an investor, you have to create a conducive environment for them to conduct their business. And one of the conducive environment is that they should have a fair taxation system. So an investor will be reluctant to come into a country if they do not get this kind of relief, because they will say, even if I come there and I make money there, you will tax me and my country will also tax me. So countries had to find a way of getting investors to come into their country. And that means they had to share their taxing rights so that you agree that we want this person to trade in both our countries, but so that not to discourage them, let us agree on how we are going to tax them and how we are going to relieve them from any instance of double taxation. So that is just meant to create a conducive environment for investors in countries.
Okay, now assume I'm the viewer. I run a business, probably a medium business, both in Kenya and Rwanda or Kenya and Uganda, and I've never known about this. How do I go about it?
So usually if you're a viewer, let's say if you're in Kenya, so when you're filing your return, the authority guides you, or rather even in our system, it will guide you because it will ask you to declare your source of income. So you will say, my income is both in Kenya and Rwanda. Mm-hmm. So automatically then it will prompt you to declare if you are taxed in Rwanda. And then it will show you how you can get relief for that tax if there's a double tax agreement.
Mm-hmm. So it's an automated system. There are no processes that you have to go through.
It is an automated system for us. So as long as you have evidence that you actually paid taxes in the other country, if we have a double tax agreement with that country, then we will relieve you from the tax that you paid there.
Mm-hmm. From a KRA standpoint, what are some of the benefits that you've seen for some of these businesses that enjoy this double tax agreement?
I'd say I'll just go back to the fact that it has worked for investors because they get that relief from their tax. And it has also encouraged our businessmen to trade in other countries. Because I can tell you that one of the reasons that drives Kenya to enter into double tax agreements is, for example, our national airline, KQ. So KQ flies in different countries, right? And so they will carry passengers from those countries. So they will approach us and say that we are in this country, or rather we've started flying into this country, and so as to avoid having our income taxed here and there as well, we encourage you to get into that kind of agreement so that we can operate successfully in that country. So from that, we have seen businesses at least not shutting down because of the burden of tax, and also have seen an increase in investors, perhaps not just because of tax, but also other functions. But I'm sure not being tax raised actually helps the situation.
Okay. Now, is DTAS a blanket tax cover, or it applies to different tax brackets?
It is not a blanket tax cover. So DTA only covers taxes on income. So we have the corporate tax, which is the tax on companies' profits, employment income. So as an employee, employment income would also be covered by DTAs, dividends, royalties. If you're like a professional and you're earning management or consultancy fees, that will also be covered within the double tax agreement because it covers taxes on the income of a person. Mm-hmm.
And how many countries have signed this agreement, or it applies Africa-wide, or wherever you are, you can just apply for this?
DTA is usually a bilateral agreement. So it's two countries agreeing to sign. So for Kenya, we currently have around 15 DTAs that are in force that we are actually implementing. So just to name a few, we have a DTA with South Africa, with the UK, Canada, France, Zambia, just to name a few. But it's usually bilateral. So a country approaches, if you want to have a DTA with a country, you approach that country and make a request. Then they review it and decide if it is something that makes economic sense to them. Then they would agree to negotiate it. And then now you go through the process of negotiating the DTA.
Okay. Now, I want this to get slightly personal. I'll start with my question. I did a gig for somebody, and then as I was waiting for them to pay me, they said, give me your KRA PIN. Does that mean they're going to tax that money before they pay me?
Did you do the gig for somebody abroad or within the country?
In the country, but it's a big organization that pays taxes.
Okay. So because when you did a gig for them, what you're offering your professional services. Mm-hmm. So when they're paying you, they're required to withhold tax. So that is why they were asking for your PIN. So when they withhold tax from your payment, then that tax is recorded now in your account. It's credited to you as you have paid tax. So at the end of the year, when you now have your final, accounts, you know how much you've earned for that year, and you're computing your tax. So when you come to file your return, the system will tell you, yes, this is your tax, but we recognize that there's some tax that had already been withheld. So we will reduce your final burden by what had already been withheld in advance. So that is why they were asking you for your PIN.
So who's paying for that money, them or me?
They were deducting it from the payment from you. So it is you who has paid the tax. They just withheld it as an agent.
Okay. That was difficult to hear, but I mean, tunalipa ushuru tunajenga nchi. How about athletes? you know, do they get taxed like the prize money that they get? I mean, you break course record, you break world record, you're given money. So is it taxed, or for theirs it's safe, they're doing a duty for the whole nation?
Like you say, tunalipa ushuru, tunajenga nchi. So yes, athletes are also taxed. And athletes, they could either be employees, they could be employed as athletes, or that could be their profession, their vocation. That is their trade, that is their business. So our laws say that if you have your business and you're conducting it both in Kenya and outside Kenya, then that income is taxable in Kenya. If you're employed, your employment income, whether earned in Kenya or outside Kenya, will be taxable in Kenya if you are a resident of Kenya. But again, remember, we will give you a relief. Yeah. So for an athlete, if he has now that prize money, maybe he went for a marathon in London, right? So perhaps the UK will tax that money. So when he comes to Kenya to declare, he will say, this is what I won, but this is what I paid in the UK. So when we are computing his tax, then we'll allow him to deduct what he has already paid in the UK. So that way, again, he does not suffer double taxation.
What if I don't declare?
We will find you. Well, we have, of course, now we see you. we hope that you declare, because we encourage a self-assessment regime, right? Because our motto is to facilitate taxpayers. So I don't think it would be advisable for you to wait for KRA to come and find you, because it is your duty as a Kenyan. You have to agree. We all have to build this country. No one can build the country for us.
Okay. Yeah? Also, by what margins? Because it's not just me who's shocked. I'm so sure there are people out there who are at our Meitisho KRA pin and they're like, okay, what do you want it for? So by what margins? So that I just know the dent on that money.
It depends, because for individuals, we tax you, we usually have on, what is the word? I'm trying to look for a simple word. On a graduated scale, so to speak. So if your income is between a certain amount, it's at 10%, then it goes up to 15, 20. The maximum now we do is 25%.
So what's the 10% so, bracket?
Anyone who is earning income, wow. That one I have to confirm. But as you know, that this year, because of the COVID, we completely exempted persons earning 24,000 shillings and below. So it's between 24,000 to a certain bracket. I'm sorry, I don't have those ones off my head, but that is how it is. It's a graduated scale, so as to make sure that if you're earning more, then you pay more.
Are there people who are exempted from paying taxes?
Yes, there are.
Besides the COVID relief package. Yeah.
Besides the COVID relief package?
Who are the people who maybe are exempted?
We have various exemptions that are specified in the Act. I'll give an example. For NGOs, for example, who are involved in alleviation of poverty, distress, or they're offering sort of healthcare. So what they do, they can apply for exemption. It is not automatic. So you have to apply for the exemption, and then you have to demonstrate to the commissioner that your income specifically goes to these activities, right? So that way, if the commissioner is convinced that you're actually within the provisions of the law, your income is used for alleviation of poverty, alleviation of distress. So institutions like the Red Cross. So they will come and say, this is what my income is for. It is not for profit. I do not share it with the shareholders. It is purely for this NGO purposes. So in that case, then they can get exemption for that kind of income. There are also for persons with disability, they get exemptions of their income up to a certain amount. It comes to around 150,000 per month. So just to give them an ability to deal, since already they are persons living with disability, just to cushion them, because they might need extra help than those of us who are not disabled.
Okay.
So they also get some exemptions. There are other lists also, yeah. It's quite a significantly long list, but not very long also.
Okay, I'll see you on the side so that you can also explain to me the things that I do if I can apply for tax breaks. But here's another scenario. I'm a Kenyan, say I work in Ghana. Will my salary be taxed in Ghana, and also I'm expected to remit taxes in Kenya too? Okay,
so you're a Kenyan citizen. You work in Ghana. So you live and work in Ghana?
Yes.
You live and work in Ghana. So like I said, for employment income, we tax on a worldwide basis, right? So if you're a Kenyan resident, you're taxed on your employment income, irrespective of where you earn. So in a year of income, let's say if you worked in Ghana in 2019, so what I will ask you, between January 2019 and December 2019, were you in Ghana the whole time, or were you in Kenya at any point, right? So if you're in Kenya at any point and you meet the threshold for being a resident, then you will be required to declare the income that you earned in Ghana, yeah? So of course, Ghana will have taxed you because I'm sure they operate payee same way we do. So the employer has deducted. So when you declare your income in Kenya, you will say, I paid payee in Ghana of this amount. So Kenya then will allow you to deduct the pay that you paid in Ghana and only tax if there's any more tax that you should pay, right? So you can find maybe the tax rates are comparative. So let's say if you earned 1 million shillings in Ghana, right, for that year, Ghana taxed you at 30%, just generally, let's just say for an example, 30%. So you paid 300,000 in tax, right? So you come to Kenya, if you're computing tax on the same income, it comes to also 300,000. So in that case, you will not pay tax in Kenya because you paid the entire 300,000 in Ghana. So you get a relief. But if Kenya was taxing at 40%, so the tax is 400,000. So you will be told you're supposed to pay 400,000, but you already paid 300,000 in Ghana. So now you'll only pay us 100,000. But that I have to stress on Diro is only if you are resident in Kenya in that year of income. So we have to determine that you are resident in that year of income.
Okay, good. I have so many questions, and there's so many questions here, but I'm trying to sieve through them and see how we can go about this. Okay. Now, in terms of declaring, you know, sometimes you go to a shop and you want to pay, and then they say, "Acha niashe," I don't know, there's this machine that they use and say, let me use it so that KRA knows that I'm selling, so they don't come here and ambush me. Yes. Explain to us how that works.
So that is what we call an ETR machine. So that means that the person who is selling you the goods or whatever it is you're being sold is subject to VAT, right? So VAT now is a different type of tax. It's a consumption tax. It is a tax you pay when you consume. So the person who is selling you then has to give you an ETR receipt, because for them they're required to declare the VAT they have charged you when they are filing their return. And the reason why an ETR receipt is good for you, especially if you're a business, for example, if you are buying goods for your business. If you're a business, then you're probably also charging VAT for your services or your goods. So if you got an ETR receipt when you are buying them, you are able to claim the VAT that you are charged. So that is why that ETR receipt is very important.
Okay.
It enables you as a business person to claim your input tax.
Lena, 30 seconds. What are some of the benefits for businesses? I know, difficult as it may sound, you have to remit your taxes. What are some of the benefits of doing this?
So the benefits of remitting your taxes is because you have to remember tax is how the government finances its expenditure, right? So you see the roads that the business would like to use, the electricity that you use, any infrastructure that you use in the country. Tax is our main source of revenue as a government. So if the government does not have tax, then the government cannot facilitate you as a business to grow and to make more money for yourself. So that is why we encourage people to pay your taxes as individuals or even as business, because that is the only way that you can have a good quality of life as a citizen in this country.
Lena, thank you for making time. That was very emancipating.
Thank you so much, Ondero. It was a pleasure.
Great. Now, we have been with you here since 7 a.m. It's almost 9 a.m. today, this Thursday of November. We're grateful that you made time to join us. We hope that the conversations we've heard today have had even the slightest of impact in your day-to-day business, or will inform your business decisions going through the day-to-day. My name is Ondero Ganga. I've been standing in for Elijah Charles Simbakege. I'll see you again tomorrow. Have a good day.